the different commodities that one can trade. I think that's where I left off, and I'm going to pick from there. As a forex trader, you should be very versatile, and it requires one to have sufficient skill when it comes to trading forex. I believe that probably around 4 to 6 months would be an adequate time for you to learn about the forex market, and for you to have over 2 months experience when it comes to trading on a demo account, so that you can be able to monitor your P&L. Your P&L is basically your profits and losses tab. When it comes to trading forex, there are different commodities. As I had mentioned before, there are commodities which are variety of gold, which are probably metals and indices. We have currencies, which are practically what I've been explaining about, your Euro USD pairs, your practically the currency of the country you come from. It can be traded in the forex market. Something else that can be traded in the forex market is something we call indices or indexes. Indexes are the Fortune 500 companies I have mentioned. Indices are derivatives of the indices now. We'll dive deep into that much later, but as for now, I'm going to talk about brokerages and what should you look out for when you're choosing your broker, and what would be the best for you as a forex trader when it comes to trading. The first thing you should look at is, when it comes to your brokerage, is if the broker is regulated, and regulated by the Capital Markets Authority. For example, from where I come from, Kenya, your brokerage has to be regulated by the Capital Markets Authority, or the financial authority based in your country. That's number one. So for you to avoid paying taxes or hefty tax bills, you need to get a brokerage that is registered in your country of residence. Or if you're using a foreign brokerage, you have to be aware of how you're going to file your tax returns, and how you're going to avoid certain inconveniences, whereby when it comes to communication of certain funds that have been misplaced, or communication with practically your customer service. When it comes to trading forex and you're establishing what broker you're going to use, as you've been trading, you need to understand what type of commodity or asset you're going to be trading, and if this asset or particular commodity is being offered by the said broker that you are willing now to establish a account and now start trading with them. If the brokerage is not offering that commodity that you want to be traded, then you must sift through the brokerages now that are being offered and choose which one is best for you. Also, leverage is something that you should take into account. When it comes to leverage, I've explained how your $1 can be used to operate 200 US dollars within the same market. So if your brokerage is only offering said leverage, then you need to change your brokerage to, because there are certain brokerages that offer you a variety of leverage specifications. So you can get a brokerage that offers you 1:1 leverage, 1:100, 1:200, 1:2000. So based on the amount of money that you are willing to make or lose, you have to take into account that. When it comes to trading forex, you need to also take into account your internet connection, because if you're using a foreign brokerage or a brokerage that is not registered within your country of residence, your internet needs to be very high, so that your market executions are sharp, so that it doesn't take time before your order is placed or your order is fulfilled, so that once you want to enter the market, you're able to enter the market sharp. Before selecting an online broker, you should closely examine the features and policies. These include the available currency pairs, transaction costs, margin requirements, minimum trading size, rollover charges, margin account interest rate, and trading hours. Let me dive a little bit. I think I've talked about available currency pairs. I've talked about transaction costs. Some of the transaction costs that you may incur things like swap charges. So once you leave a trade running overnight, there's something called swap. So for your order to be for your trade to continue running, when the market is closed during the for a short period, there's something that is called a rollover charge or swap. So you should pick a brokerage that offers the minimal amount of swap. Margin requirements, for example, let me dive a bit into that. The lower the margin requirement, meaning the higher the leverage, the greater the potential of higher profits and losses. Margin percentages vary from 25% and up. Lower margin requirements are great when your trades are good, but not so great when your trades are wrong. Be realistic about your margin requirements, and because they swing both ways. Trading is a very high risk game. It involves a lot of mental fortitude, because you need to be able to establish when you're going to enter the market position and not let fear or market bias affect you, or market psychology affect you. You should be able to always make your decisions by yourself and trust in your trades, because leverage works both ways. Leverage works in the sense that if your trade is, if you have a account leverage that is 1 is to, for example, 200, the same effect that it has on the profit tab is the same effect that it will have on the loss tab. So if you're making any amount of money multiplied by 200, sorry, if you're making any amount of money, it means that your $1 that you're using is leveraged to 200 times. So if you're making $1, it's the same as making $200. If you're losing $1, it's the same as losing $200, and the profit or losses is incurred to your equity, which is the amount of money that you've deposited into your account, then that you'll be trading with. So it involves a lot of risk, so you have to be very careful. You have to use something called risk management. You have to use calculated risk when it comes to trading. Certain brokerages offer a variety of commodities, which I've already explained, and you should always pick the brokerage that offers you the lowest spread and also the lowest deposit and withdrawal amount. So there's some brokerages that offer you accounts that you cannot deposit anything less than $250, others $50, others you can even deposit $1. So you should always be able to pick something that is flexible within the amount of money that you're willing to risk. When it comes to trading, you should always make sure that you do background research when it comes to your brokerage. For example, I trade using Ingot Brokers Kenya, which is registered in Kenya, but they have branches all over the world. I also trade using, but they do not offer indices. So I trade indices using Deriv Broker, which was formerly binary.com. Deriv, DERIV.com. That is a brokerage that I used to trade indices. But when it comes to trading stocks, or when it comes to trading currency pairs, I use Ingot Brokers, ingot.africa.com. Yes, so I think that is all that I've had planned today for you guys. We'll get into the nitty-gritties. For example, what is a pip? A pip is basically a fraction of movement in the market measured against now whatever you're trading. So a pip is just if the price of a certain commodity has moved by, for example, 0.16, that fraction of movement is referred to a pip. We'll get into the other nitty-gritties. For example, ask price, bid price, base currency, cross currency, margin, what leverage is in depth, margin calls, placing buy and stop losses, buy stop orders, market executions. We'll get into much of that later once I have the screen set up for you. We'll also get into opening an account with Ingot Brokers, opening an account with binary.com or derive.com. And once we are getting to do that, I hope each and everybody will be at the same page. So thank you very much for your time. My name is Brian Onyango again. Peace out.